Hey tech enthusiasts, welcome to Tuesday's edition of the Tech Stocks Daily Podcast. Today we've got a roller coaster for you. Supermicro Computer's dramatic showdown with Hindenburg Research and a juicy shareholder lawsuit. Google under the DOJ's magnifying glass with potential earnings fallout. GoDaddy soaring on AI-powered innovations, and Braze bracing for a pivotal earnings report. We'll break down the twists and turns you need to know. Stay tuned. It's going to be wild. All right, tech world, strap in because today's spotlight is shining brightly on Supermicro Computer. Boy, do we have a roller coaster for you. From tantalizing CEO letters to shareholder class actions, Supermicro's been shaking up the NASDAQ with full-on drama. Grab your popcorn and let's dive in. First up, Supermicro Computer's CEO Charles Liang took to the virtual stage to address concerns that have been buzzing around like tech-savvy mosquitoes. Recently, there were two major points causing jitters among investors: the delayed filing of the company's annual report and a scorching short seller report from Hindenburg Research. Liang penned an open letter to Supermicro's customers and partners, clarifying that these hiccups don't imperil their core business operations or ability to innovate. According to Liang, the accusations haven't thrown any wrenches into their gears. They're still cranking out cutting-edge IT solutions at warp speed. He also confidently rebutted the Hindenburg report, branding it as full of false or inaccurate statements. Spicy stuff, right? Investors seem to be giving Liang a thumbs up, with SMCI shares trading 2.37% higher, now sitting at $448.06. But hold your horses, because the stock is still chilling below its 50-day moving average of $707.78. Analysts are divided like a pizza on Super Bowl Sunday. Wall Street forecasts give SMCI a 12-month price target averaging $700.82. Some are super optimistic, with highs of $1,300, while others are cautious, with lows of $325. Given SMCI's stock has risen 59.7% year-to-date, there could be more room for growth. And while the CEO letter offered some much-needed reassurance, investors shouldn't be too hasty. Analytical heads must dive into every inch of sniffable data to see where this is headed. News like this doesn't just disappear into the cloud, after all. Slide over to part 2 of our Supermicro extravaganza. Supermicro Computer is also feeling the heat from the legal stove with a freshly baked class action lawsuit, courtesy of Robbins LLP. These lawyers aren't messing around. They've thrown allegations from here to Narnia, asserting that Supermicro might have been a bit too creative with its accounting. The claims? They overreported sales, underreported expenses, rehired execs from previous accounting scandals, maintained an under-the-radar number of related parties, and somehow didn't stop exporting to restricted areas during the Russia-Ukraine conflict. Legal thriller, anyone? Hindenburg Research blew the whistle page style, claiming a seismic catalog of accounting red flags and secretive business dealings on August 27, 2024. This revelation saw SMCI shares nosedive 21.6% in 2 days, from 562.51 to 443.49. It was like the financial equivalent of finding out Bitcoin isn't accepted at your local coffee shop. Legal eagles who bought Supermicro shares between August 10, 2021 and August 26, 2024 are prepping their briefcases to potentially co-lead the charge before the court's October 29, 2024 deadline. With Robbins LLP promising to only get paid if they win, this legal saga guarantees it'll be juicier than an episode of Suits. So that wraps it up for Supermicro. Keep your eyes peeled for further twists and turns, because something tells me this wild ride is far from over. That's it for today's thrilling tech popcorn. Catch you on the next one. No curtain call necessary. Today's hot tech headline revolves around Google facing potential financial turbulence, all thanks to a courtroom drama unfolding with the Department of Justice. According to JP Morgan analyst Doug Anmuth, the latest trial proceedings have the potential to dent Google's earnings by up to 10%, or in a worst-case scenario, an even steeper 20%. So what's cooking in the courtroom? The DOJ has kickstarted remedy proceedings against Alphabet Inc., Google's parent company. Anmuth breaks it down, saying the judiciary won't settle for the status quo, and any decided remedy is likely to put Google in a financial bind. We're talking everything from punitive measures to a potential breakup of Google's prized possessions, Chrome and Android. One scenario under consideration is forcing Google to open its search distribution channels to rival search engines. Imagine Google having to invite competitors into its most visited spots, like Android and Chrome. While Google would still pay for traffic acquisition, it would also have to allow competitors a piece of the pie. This prospect of opening up could wreak havoc on Google's earnings per share. Depending on the judge's ruling, this could shave off up to 10% from Google's EPS, with Anmuth painting a grimmer picture where it could plummet by 20%. Talk about rough. Of course, Google's legal eagles could drag out the appeals process for years, which might give the company some breathing room to pivot towards other growth avenues, like generative AI and cloud services. Even then, a ruling favoring drastic structural changes, such as breaking up Google, is seen as unlikely by Anmuth. Instead, offering more choices in their platforms might suffice to achieve the DOJ's goals without busting up Google's ecosystem. But let's not ignore the elephant in the room: consumer impact. A breakup or forced patent sharing could end up messing with user service quality. Moreover, privacy concerns could blow up if Google is compelled to share proprietary data with its rivals. Anmuth notes that while the government aims to clip Google's wings to boost competition, the ultimate price could be high stakes in consumer privacy. So Google finds itself at a critical juncture. This DOJ trial could deeply shake its foundational business model. However, this isn't all doom and gloom. It's a moment for Google to reflect and potentially reconfigure its broader strategy, leaning more into other promising sectors. Whatever happens, Google's actions in response to the trial's conclusion might redefine its future standing in the industry, forcing every tech enthusiast to stay on the edge of their seats. Buckle up, because this legal roller coaster could tremendously impact not just Google's trajectory, but the entire digitized universe as we know it. Hey tech enthusiasts, buckle up because today we're diving into why GoDaddy is the talk of the NASDAQ town. Spoiler alert, they're on fire in the stock market. So what's causing this buzz? Well, GoDaddy has been surging phenomenally this year. We're talking a mind-blowing 57.7% year-to-date surge in their stock price. That's like finding a unicorn in your morning coffee. While the broader tech sector has appreciated by around 20.7%, GoDaddy has outperformed major names like Alphabet, Shopify, and BigCommerce. Alphabet managed a respectable 16.9% rise, but unfortunately Shopify dipped by 4.9%, and BigCommerce plunged a harsh 39.8%. The magic behind GoDaddy's stock juggernaut? A vibrant cocktail of better-than-expected financial results and an inventive growth profile. In Q2 2024, GoDaddy reported revenues of $1.2 billion, up by 7% year over year. A lot of this boost came from their applications and commerce segments, where they've been crushing it. A key ingredient to GoDaddy's secret sauce is their AI-centric initiatives. Take GoDaddy Aero, their AI-powered platform that has not only boosted customer engagement but also reeled in over 1 million new customers. More than 500,000 actively engage with Aero, which they're planning to roll out in over 90 countries. Think of it as their digital world tour. And if you think that's impressive, enter Gabby, their internal AI-powered guide assist bot, fluent in over 60 languages. With features like these, customer interaction and operational efficiency are getting a serious upgrade. Now, let's talk small businesses. GoDaddy's pretty much become the patron saint for them. They've launched the Digital Marketing Suite, arming users with personalized marketing tools so potent that they don't even need a website to make waves. Expanding on this, they upped the ante in May with the Small Business Gen AI Prompt Library, boasting over 185 updated prompts to supercharge small businesses around the globe. And if you thought they'd stop there, think again. Just last month, GoDaddy introduced another ace, digital marketing, an all-in-one solution to streamline marketing with AI-powered tools, social media integration, and a unified inbox for small business owners. This expanding portfolio is not just fan service lip service. It's drawing numerous small businesses and padding GoDaddy's top-line growth. Looking forward, GoDaddy expects Q3 2024 revenues to hover between $1.13 billion and $1.5 billion, a projected year-over-year uptick of about 7% at the midpoint mark. The consensus estimate pegs it at $1.14 billion, translating to a sturdy 6.83% growth from last year. Not only that, their earnings are forecast at $1.25 per share, which has even nudged up by a penny in the past 30 days. But whisper this softly, the financial analysts give GoDaddy stock a Zacks rank number 3, with some reservations about their current valuation. Trading at a price-sales ratio of 5.50x compared to a sector median of 3.86x suggests a not-so-cheap stock. So is it time to buy? Maybe approach with caution and wait for a better entry point. Regardless, GoDaddy's impressive playbook shows they're not just a player in the market, they're a frontrunner. So, there you have it. GoDaddy's blend of stellar financials, AI advancements, and an all-in approach to supporting small businesses has powered its YTD surge. Keep an eye on this dynamo. They're mixing innovation with expansive growth, and that's a winning combo. All right, folks, let's dive into why Braze has been making waves in the tech world today. First off, Braze, the customer engagement platform, is set to report its second quarter fiscal 2025 results on September 5th, right after the bell. Big things are riding on this report, and analysts are buzzing about what might happen. So what's the scoop? According to the Zacks consensus estimate, Braze is expected to report a loss of 3 cents per share. That's a bummer because it's a 25% dip from the same quarter last year. However, it's not all doom and gloom. The good news is that revenues are projected to hit $141.1 million, showcasing a solid 22.6% year-over-year growth. Not too shabby, right? Historically, Braze has been a bit of a superstar when it comes to surprising analysts. Over the last 4 quarters, the company has consistently outperformed expectations by an average of 50.7%. That's some top-notch performance. But sadly, our crystal ball isn't signaling another earnings beat this time. The combination of their 0.00% earnings ESP and a Zacks rank of number 3 doesn't quite tilt the scales in their favor this go-around. Year-to-date, BRZE shares have been on quite the roller coaster, currently down 15.7%. But if you've been holding on to those stocks for the last 3 months, you've probably noticed a 21% uptick. That's like finding an extra packet of your favorite snack in the cupboard when you thought you were all out. Competing giants like Salesforce and HubSpot have also seen some red this year, but Braze has managed to keep pace with its industry, which has generally grown around 21.3% in the same period. Taking a deeper dive into Braze's business strategy, their focus is laser-sharp on expanding their customer base across various sectors like retail, media, entertainment, gaming, health, lifestyle, and financial services. They're throwing their weight behind industries that are riding the digital transformation wave and doing it with style. A key part of their strategy includes leveraging their sales and marketing muscle to capture direct-to-consumer markets, especially in consumables. Braze isn't just resting on its laurels either. They're continuously enhancing their platform to accommodate more sophisticated tiers of customer engagement, rolling out new channels and boosting messaging volumes. They're also diving headfirst into AI tools to help their clients analyze customer data better and are committed to expanding partnerships to deliver even richer offerings. So given all this juicy info, what's an investor to do? The experts suggest playing it cool for now, holding your positions and watching how the upcoming earnings report plays out before making any big moves. With mixed performance indicators and stock volatility still in the conversation, it's probably best to wait until the air clears a bit post-earnings announcement. What do you think, folks? Will Braze pull off another surprising win, or is it time to be cautiously optimistic? Drop your thoughts in the comments below. We love hearing what you have to say and are always up for some lively discussion on these stock market twists and turns. Let's get the conversation rolling. Let's talk about today's headliner, Google. So folks, with the looming DOJ trial and analysts forecasting a potential 10 to 20% dent in Google's earnings per share, things are looking rather dicey. To recap, the Department of Justice is gunning for Google, potentially even pushing for a breakup of its major assets like Chrome and Android. And yeah, that's as serious as it sounds. Imagine Google being forced to open its search distribution channels to rival search engines. It's like being told you must share your phone's password with everyone at the cocktail party, all while pretending everything's fine. Awkward, right? JP Morgan analyst Doug Anmuth thinks the court's not going to maintain the status quo, so Google couldn't just kiss its current cozy setup goodbye, but might even have a new playing field to navigate. However, it's not all doom and gloom. Remember, Google has heavyweights in their corner, including generative AI and cloud services, which could offer much-needed lifeboats. Yes, they might have to decay bits of their core model, but adaptable as they are, this giant isn't going under anytime soon. Even with the dark clouds of legal peril, this potential shakeup could force Google to innovate more aggressively outside their search giant comfort zone. Given this, I'd put Google in the hold category. The situation is uncertain, but selling might be too hasty, especially considering the robustness of their broader portfolio. Wait out the legal saga, see how Google's strategy evolves in response to the trial, and keep an ear to the ground for any surprising twists. Remember, the stock market is an unpredictable beast, and while my take is to hold and observe, it's vital you do your own research. Consult with financial advisors, check multiple sources, and make sure any move you make fits your risk tolerance and financial goals. So what do you think, folks? Do you agree with my hold on Google? Drop your thoughts and let us spark some conversation. All right, Tech Squad, let's recap today's wild ride on the NASDAQ. Super Microcomputer is like a tech thriller with CEO Charles Liang trying to clear the air amidst legal thunderclouds and a spicy short seller report. Google's facing its own drama with the DOJ, casting shadows over its future earnings. GoDaddy is skyrocketing, waving the AI flag, and turbo-boosting small businesses, making it this year's tech darling. Braze is gearing up for an earnings report that could either soothe or stir investor nerves. If you enjoyed today's roller coaster of tech news, don't forget to hit that like button, smash the subscribe, and share this video with your fellow tech enthusiasts. Catch you tomorrow for another whirlwind of the latest in tech. Stay tuned.